Roth conversions can be a great way to maximize your after-tax income in retirement, and it can seem like a really alluring and a smart strategy, but sometimes people get carried away, and because of that, sometimes people tend to overdo it. They might convert quite a bit more than they need to, or maybe they don't even need to convert at all. And so, in that way, Roth conversions can be like chocolate cake. In other words, it's possible to have too much of a good thing. So, for the next couple of minutes, let's chat about the types of conversions I'm getting at here and some of the potential pitfalls of converting more than you need to or making unnecessary conversions. So, we're primarily talking about converting pre tax money to after tax money. So, not necessarily those backdoor Roth contributions or mega backdoor Roth contributions. Those are pretty much a gimme and often a good idea, although there could be some complications where it's not right for you. But really, we're talking about where you go into retirement, let's say, with a large lump of pre tax retirement savings in your IRAs or your 401k plans, and you decide to do partial Roth conversions. In other words, each year you might decide to convert a certain amount of your assets from pre-tax to Roth. And when you do that, you are prepaying your taxes. So you're effectively saying, I would rather pay the income tax on that now so that, assuming I follow all of the IRS rules, I don't have to pay any income tax on the distributions from that account later. So it can set up some really nice tax-free income for you later in retirement, again, assuming you meet all of the IRS requirements. And so let's acknowledge really quickly what some of those advantages are, the potential benefits of this strategy. First, you have tax diversification. So you have a variety of different accounts that you can pull money from later in life, and that can be helpful in managing your taxable income. So if you know your income is reaching a certain level that you don't want to go above, maybe it's going into a different tax bracket, maybe it's going to cause you to pay additional premiums for health coverage, then you can say, look, I'm going to draw some extra money for this emergency, for example, out of my Roth account, and that way I won't bump up my taxable income to cause some problems. And that's nice to have choices on where you pick and choose your income from. This can also help you to smooth out your income, and that can work in a variety of ways. I mean, the traditional view of Roth conversions is to say that I'm going to pay taxes when I'm at a relatively low rate so that I don't have to pay taxes at a relatively higher rate later. So that's great. It can certainly help you to choose at what rate you pay taxes, assuming you can predict accurately what will happen. It can also prevent some spikes, and maybe this gets us into the next one as well when we talk about the RMDs. For example, if you know that you have a relatively big pre-tax retirement account, then after age 72 or whatever age the lawmakers make it, you might have to start taking those required minimum distributions or the RMDs. That can cause you to have a sizable income later in life because you have to take distributions. Those are intended to cause you to take out taxable distributions. And so if that's going to cause any sort of issue or have you pay taxes at higher rates than you necessarily need to, then it can make sense to pull those tax liabilities forward and again go ahead and convert that money before you have to pay taxes on it, because maybe you can do so at a lower rate, and then you smooth out the rate at which money's coming out of those pre-tax accounts, and presumably you can avoid getting into the higher tax brackets. Conversions might also help you manage Social Security taxation. So a portion of your Social Security might be taxable if you have big pre-tax balances. For most people, it's going to be hard to completely eliminate over your lifetime taxation on your Social Security benefits if you have saved quite a bit in pre-tax accounts. But doing some Roth conversions could help to reduce that, or maybe you can even set it up so that you don't always pay Social Security tax. It just depends on the numbers. And along similar lines, you can potentially manage the costs you pay for health coverage. Now, this is a tricky one because you might have some conflicting goals here. On the one hand, you might want to take some income early, do some conversions, and go ahead and pay the taxes and recognize that income before you necessarily need to. On the other hand, you might want to keep your income relatively low so that you qualify for some lower health coverage costs. And that's true whether you are before age 65, maybe you're getting those ACA credits or those tax subsidies, or even after age 65, you need to be mindful of what your income is. After age 63, actually, you want to be mindful of what your income is because that can potentially cause you to pay those IRMA surcharges or pay an extra amount each month for your Part B and your Part D premium. So being careful about your income is really important in terms of health coverage costs, but it can also be tough because figuring out the right amount of income to take is tricky because again, you've got these conflicting goals. Roth conversions can also help if you're planning for single life. So if you happen to be married and you're filing jointly, well, when one of you dies, and that could happen at any point, unfortunately, the survivor would likely go into a single tax filing status at some point. And what that means is that if they have a similar income as they did before, and they probably will, to maintain that standard of living, yes, some expenses will drop, but overall it might be a pretty similar income. Yeah, a Social Security check goes away, for example, but that person is going to get into higher tax brackets with a lower income. So it could make sense to say, let's convert some assets to Roth so that if there is a so-called widow's penalty risk, then we can potentially reduce the problem. And maybe you're not worried about any of those things, but you just think that tax rates in general will rise in the future. So you might say, I don't know exactly why, maybe you have to pay for a bunch of stuff, but let's just say for a given level of income, my expectation might be that the tax rate would be higher for that same level of income in the future than it is today. That's, hard to predict the future. It's a reasonable assumption to make, but only time will tell. And, maybe they go to consumption taxes or value added taxes to supplement income taxes. I mean, this can backfire, but it is also reasonable to plan for the future and say, look, tax rates are pretty low today, so I might consider taking advantage of some of those relatively low rates. By the way, I'm Justin Pritchard, and I help people plan for retirement and invest for the future. And in the description below, you're going to find some more resources on this topic. So there'll be links to some of these things we're looking at and additional videos that kind of supplement the topics we're looking at. Also, just some general retirement information. I think you'll find it helpful. Different resources that give you a big picture view of what retirement might be like. This is also a good time for a friendly reminder that this is just a short video. It can't possibly cover everything. It's not individualized advice, so please read all of this carefully as it is very important. So let's get into some of those potential pitfalls of Roth conversions. And the first one might be that we don't necessarily know if your future tax rate is going to be higher than today's tax rate. So by paying taxes today to convert to Roth, it could potentially mean that you're paying at a higher rate today than you would in the future. The best way to figure that out might be to run some numbers, do some projections on some calculators, financial planning tools, etc., and that may give you an idea. By the way, the Center for Retirement Research at Boston College looks at this periodically, and they show that on average, households might pay about 6% at a 6% rate in retirement. Now, that's going to include all households. So that includes wealthy people and people who don't have wealth. So what does this look like for most people? I mean, I see with clients, they are often paying at a relatively low rate. It might be in the single digits or the low double digits. People are often surprised. I mean, after a standard deduction, plus you might also have some state level tax benefits that help to bring down that total all-in rate. But we can look at the top 5% are paying it at about 16.4% according to this study. That might be lower than you expect. I don't know what rate you will be paying at, especially given your local situation, but be sure to actually run some numbers so that you can be confident that you are paying at a time when it's most likely to be the lowest rate. There's also the matter of the money that you pay out to cover the tax payments. So those tax payments, the resources that they use up, could affect your ability to pursue other goals, financial and non-financial. So maybe you'd rather use that money to take vacations and enjoy life and make memories. Now, we want you to have a smart, long term financial view when you make decisions, but at the same time, we also want you to enjoy your life because nothing is guaranteed in this world. You have to remember that there's no scoreboard that shows how much tax you paid over your life, and the main thing that matters is that you paid as little as possible. What's really most important is that you made the most of your life and that you made some smart decisions. And so, even with financial choices, these taxes can draw resources that you might put towards other things. In some cases, for example, if you're not paying down debts because you're using all of your money to convert to Roth, that can potentially be problematic for you later or just not the best decision. So there are a number of things to think about in terms of how do you use this money that you could put towards tax payments on Roth conversions. Is there something else or something better that it could go to? Again, being responsible with our decision making. Next, we have the impact of this higher income. And again, that can cause some issues elsewhere for you. And this sort of goes back to those health coverage discussions in terms of, is taking a higher income going to mess up your ability to get low cost coverage, let's say from a marketplace or an exchange or through Medicare? But it can affect other things as well. There are a number of different things on your tax return where you might qualify for certain credits or deductions, but if you have a really high income, then that can disqualify you from those things. So you want to be careful about bumping up your income so that you can do those conversions, because it could have other unintended consequences. If you give money to charity, that can point towards leaving at least some of your assets in pre-tax retirement accounts. That's especially critical if you want to leave your pre-tax account to a tax-exempt charitable organization. And that's because the organization would not have to pay income tax when they sell the assets and use it to fund their operations. But if you convert or if you use after-tax money to make your contributions to them, you are effectively paying taxes that don't necessarily need to be paid. And in fact, by doing that, you could potentially end up leaving them with less. So you can maximize your impact if you're leaving a pre-tax account to a charitable organization, a qualifying charitable organization, by not doing those Roth conversions. Even when you're living, these pre-tax accounts can be helpful. So once you're over the age of 70 and a half, and this gets confusing because it's not age 72 for the RMDs, it's the old RMD age of 70 and a half. Once you're above that age, you can use qualified charitable distributions to give money, or QCDs, to give money to qualifying charities. And when you do that, you give the money directly from your pre-tax IRA to the charity, let's say. And as a result, that money would not show up or be included in your income. So if you do that, you don't have to get the money and then donate it and then deduct it and deal with all the mechanics of that and the calculations and the limitations of that, plus messing up other things on your tax return. If you do the QCD, you can just send the money directly from the retirement account to the qualifying charity. And again, that's a great way to make an impact with pre-tax dollars. So should you avoid making Roth conversions? And the answer is probably not. But what I see sometimes is people get maybe over enthusiastic about it, and they might end up doing a little more than they need to. It can feel good to make these really smart decisions that impact your future and can even impact those who you leave money to. But I think the right way to go about it is to actually run some numbers and say, I'm going to convert roughly the right amount for this year to make my situation better, as opposed to saying, I'm going to convert everything I have, or I'm going to convert as much as possible. So maybe you figure out a good amount to convert and you're doing it in the years between when you stop working and start Social Security or start taking RMDs, and whatever makes the most sense for you, that's what you go with. And look, if you have more money than you know what to do with and you want to go ahead and convert everything, prepay the taxes so that you can leave assets to the next generation, then more power to you. You can do that as a conscious decision. But with most of the people I end up talking with, that's not the case. So I hope you found that helpful. If you did, please leave a quick thumbs up. Thank you and take care.